Both the Dow and the S&P 500 seeing the worst day yesterday since September 6th as oil prices and treasuries rose. Join us now at the technical levels that he's watching. Jason Hunter, head of technical strategy at JPMorgan, 22 and change on the VIX. There was some weird repo stuff going on long-term. The 10-year has been headed higher. Yeah. Are there concerning underpinnings, or is it all systems go?
So I think it's a little confusing given the leadership changes we've seen since midsummer in the equity space, where you've had defensives and cyclicals rally at the same time and kind of take the baton from tech, which doesn't entirely make sense. It looks like the market's trying to make both tail risk bets at the same time going into the September FOMC. But regardless, that's got the S&P having broken out after the FOMC up against an all-time high, which from a pure just chart-based perspective is a positive. It's maintained that breakout. Hasn't been able to build on it, but the breakout's a breakout.
That's the question, I guess.
Yeah.
Is it going to break out, or is it not? Is it going to go down? And do you see any signs that we could be topping out?
So I would say when you take the big step back and some of the commentary we've had over the last months, when you look at how long the curve's been inverted, and now you're starting to get a bullish steepening impulse, generally that tends to coincide more with bearish equity performance, at least over a short term, as the Fed's initially starting to ease. But we haven't had the data to really suggest that, recession's imminent. Some of the labor data softened, but the unemployment rates tick back down, the demand data's picked back up. And you can see the equity market is quite confused by that, again, with the leadership shift that we've seen. So at the end of the day, it's a lot of mixed signals. The individual charts across the different asset classes, you get a lot of things that don't necessarily fit together. So what I've done in the recent months is I'll take each chart at face value and leave the kind of the macro overlay aside, because the pieces aren't necessarily fitting together well right now. And if we, like I said, if we get a breakout in the S&P, a breakout in the Russell 2000 like we've had after FOMC, that's a bullish bias. I'll put my stop just underneath the breakout levels and act more like a trend follower than try and get ahead of the things, because that, quite frankly, has not worked.
Do you try to handicap geopolitical events, or do you don't even try?
No, so I think you recognize what those risks are, and I think it's more about risk management around the views and trades, where you'll set a tighter stop. Or in some of the things that tend to go nonlinear, if you think about Brent prices, where they've now traded back up into the summer range, and you recognize that just may not be a move to the upper end of the range. That could really be a blow-off. You just recognize the risks around the chart-based views, and like I said, you set your stops accordingly.
Okay, so what about the breadth of the advance right now? Finally, something that turned into a positive, or still something that makes you skeptical?
Yeah, so I think that's where you see the Russell breaking out, small cap having led large cap through the latter part of the summer. You're getting a broader breadth of things that are participating in S&P rally, which generally is a positive. That's an early cycle type story. Let's call that a bet that the manufacturing cycle globally is going to start to repair itself. And you can see with DM central banks easing, some policy news out of China, that all makes sense right now. But again, you also had defensive leadership at the same time. So those two pieces don't exactly square well together. It's a bit confusing.
People just covering their bases?
Exactly. I think that's right. And like I said, in that world, I just treat each chart separately, and I'll put my stops in place after a breakout. I'll chase that, and I'll act a bit more reactive than trying to predict where the next pivot's going to be. And hopefully things start to clear up a bit more, and we can get some foresight here. But for right now, I think being reactive and keeping tight risk tolerance is the right way to do it.
What other markets around the world are important to us right now?
So I think the rates market is a big one. In fact, when the 2-year note got to 350 recently, going into and after the FOMC, both the technicals, just looking at the chart pattern, suggest the rally looked exhausted. But when you looked at how the forward curve was priced, just how many eases they had priced into the forwards, historically, you really need the labor data to fall apart for the market to price in more. So we actually went short the 2-year note. That quickly is backed up with the help of this Friday's payroll report to a level where I don't think it goes much higher from here. We think 412 is a limit for twos. So whatever concerning, let's say, input that would have into equities, that, the Fed's not going to ease as much, we think there's a limit to that, which could be supportive if the rates market starts to find its footing and you see some rebound steepening in the Treasury curve here.
Right. Okay, Jason, good summary. Thank you.
All right, thank you.